SBI Magnum Equity ESG Fund. It's a thematic fund falling under ESG category. Will this fund really add value to your portfolio or will increase the risk of your portfolio? Will this fund help you achieve your financial goals or will hurt achieving your financial goals? Let us explore. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decisions so that you can reach your financial goals faster and smarter. Before we evaluate this particular SBI Magnum Equity ESG Fund, let us understand what this ESG thematic category is all about. Thematic funds are funds which will invest based on the theme. They can't invest in the entire stock market. They will pick and choose only companies which are based on the theme. So there is a restriction. There is no 100% flexibility or freedom to the fund manager. Fund managers' hands are tied to choose stocks only from the companies which are falling under this theme. So what is the theme? ESG, environment, sustainability, and governance. 80% of the total AUM of this fund has to be invested in ESG compliant companies. So the stock preference of this particular fund is socially responsible companies. SEBI also has mandated that from 1st October 2022, mutual fund companies should not invest in stocks if they are ESG based thematic funds. They should not invest in securities or stocks with business responsibility and sustainability report disclosures, right? So if this is not there, this report disclosure is not there, then ESG funds cannot invest. Being an equity fund, suitable only for long-term investments, it is a thematic fund. Flexibility is less, restriction is more. So maybe 7 to 10 year time frame is preferred time frame. This fund aims to generate long-term growth, not short-term capital gain. So that way, short-term money has to be avoided in this fund. We can move on to the analysis part. Before we start the analysis, let us understand what is the framework for the analysis. We are going to analyze this particular fund in 3 segments. First one is attributes of the fund. What are the key attributes that we have to analyze and understand? Next, we are going to perform few important analysis on the returns. Not just looking at the returns. We are going to understand a return from different perspective, different point of view. Then the third and the most important, risk analysis. We are going to do an in-depth analysis on the risk involved in this fund. Only if you understand both the risk and the return, you will be able to take a decision easily. What are the key attributes of this fund, SBI Magnum Equity ESG Fund? Minimum investment in this fund is 1,000 rupees. If you are starting an SIP, just 500 rupees is what important, needed. The launch date of this fund is 1st January 1991. That means this fund is there in the market for more than 30 years. It is an open-ended equity fund having an AUM of 4,246 crores, expense ratio of 1.97%. Fund manager is Rohit Shimpi. Let us dive into some deeper analysis. This fund has got the portfolio turnover ratio of 28%. Means what kind of churning they do in the portfolio, in the underlying stock portfolio. It is 28%. Category average is 197%. That means this fund has got less turnover ratio compared to the category. That means predominantly this fund follows buy and hold and very less churning or turnover they do. That means they do very less of short-term investing or momentum investing or following the trend. Those kind of things are less. focusing on long-term investing is more, which is good for investor. This is one of the positive observation. Number of stocks in this particular fund is 41, whereas the category average is 37. That means this fund is over diversifying compared to the category. Over diversification reduces risk, at the same time dilutes the return. So we have to take this data subjectively. 95% of this fund is invested in equity instruments. The portfolio invests 70% in large cap, 10% in mid cap, small cap, 1%. This fund doesn't have any capitalization restriction. That means they can invest in large, mid, and small, or in one particular capitalization alone they can invest. But this fund chooses to invest at this point in time 70% in large cap. Top 10 holdings are Infosys 7%, HDFC 6%, ICICI 5%, HDFC Bank 5%. This fund also invests in Axis Bank, Page Industries, L&T, Ultratech Cement, Bharti Airtel, Wipro. So this fund puts more importance on companies' carbon footprint, emission norms, resource utilization, and governance. So in addition to the regular quantitative analysis, this fund also puts qualitative norms like carbon footprint, emission norms, resource utilization, and governance. Sectoral allocation, top 3 sectors, financial, technology, and automobile, which amounts close to 45% of the overall investments. Financial sector, 23% is the exposure, technology, 15% is the exposure, automobile, 9%. So this fund has got concentration risk, but at the same time, we have to understand concentration can bring additional returns also. This fund has got lesser exposure to consumer discretionary, insurance, and energy. Before investing, it's better to understand the exit load and the taxation. Exit load is 1% if you are withdrawing before 1 year. After 1 year, there is no exit load. If you are withdrawing after 1 year, it is long-term capital gain. If there is a gain, you need to pay 10% tax. But up to 1 lakh, capital gain is exempted. Over and above 1 lakh, you have to pay 10% tax. Short-term capital gain, if you are withdrawing before 1 year, you have to pay 15% tax. We have understood all the key attributes of this particular fund. Now is the time to understand and analyze what kind of return this fund has delivered from different standpoint we have to analyze. First, let us analyze this fund's return vis-a-vis the benchmark. Compared to the benchmark, this fund has delivered lesser return. This fund could not beat inflation, could not beat index in 1 year, 3 year, 5 years, 7 year, and 10-year category. But not beating index, we need not take it as a negative observation, because this fund is a thematic fund, chooses to invest only in ESG stocks. So more qualitative parameters are taken into consideration. Qualitative parameters can result in more consistency in the long run. Rank also we cannot take it seriously. Why? Because this fund is kind of a monopoly fund till last 1 year. Only the last 1 year, close to 9 ESG funds are launched. So within the category ranking, 3 year, 5 years, 7 year, 10 year, there is no competition. But in the last 1 year, there are 9 more funds. So together, totally there are 10 funds. Out of those 10 funds, this fund ranks number 2, which is good actually. Rolling return analysis. What is rolling return? Instead of looking at return from one particular point, we are taking rolling return based on 1 year, 3 year, 5 year, 10 year since inception. Means from the date of the launch of this particular fund, if an investor has invested for any 1 year, if an investor has invested in any 3 year point of time, right? So there is no limitation here. If I am looking at only the last 3 months or last 6 months, the fund could have delivered negative return. If I am looking at returns for around 2021, maybe like any equity fund could have delivered positive return. But if I do rolling return, these kind of bias can be avoided. That is why we do rolling return. There are many statistical numbers in this particular table. I would suggest you to pay attention only to two important things in this video, which is maximum and minimum. In 1 year category, maximum return is 120%. In one particular situation, in 1 year category, this fund has delivered 120% return. In another situation, for one particular 1 year period, this fund has delivered 58% negative. So this shows the kind of volatility these funds can bring into your portfolio. However, if you are investing for longer time frame, like 3 years, this fund has delivered 58% positive return, 6.47% negative return in some cases. And if you are investing for 27%, sorry, if you are investing for 5-year time frame, this fund has delivered the highest return of 27%, lowest return of 0.51% return. However, if you are investing for 10-year, any 10-year period, then maximum return delivered is 20%. Minimum return is 6%. So if you are investing for long term, the risk reduces. The minimum return actually goes up from -58 to +6%. There is also another column which is negative. So in any 1 year period, the probability for generating negative return is 17%. In any 3-year period, the probability for generating negative return is 3%. Whereas in the 5-year category, the probability for generating negative return is 0.07% return. For 10-year category, this fund has not at all delivered negative return. So if you are investing for longer time frame, the possibility for generating positive return goes up. This is also an important observation you have to understand. What are the best quarters and worst quarters for this fund, and what kind of positive return and negative return this fund has delivered? There is no possibility to time the best quarters and worst quarters. So what you have to understand is you have to stay invested for 5 to 7 years time frame. During the 5 to 7 years time frame, there can be a quarter which delivers 22% positive return. There can be a quarter where the fund has delivered 28% negative return, right? You should have the mindset to stay the course with even 28% negative return or 22% positive return. You should stay the course. You should have conviction and patience to stay the course. If an investor could have invested 1 lakh 7 years back, the present value is 1,97,000. If an investor could have invested 10,000 rupees SIP every month for the past 7 years, then this fund has delivered 12,46,000. So both in lump sum as well as in SIP category, this fund has delivered definitely better return, right? As we have analyzed the return from different perspective, now is the time to compare returns along with the peers. When we compare it along with the peers, yes, only in the last 1 year there are peers. Again, this fund compared to the peers have delivered better return. The other funds have delivered more than 6% negative return, whereas this fund has delivered only 0.69% negative return in the last 1 year. Rest of the time frame we can't compare with the peers because there is no competition for this fund before 1 year. We have analyzed the return from different perspectives and standpoints. Now is the time to divert our focus towards risk. Analyzing a risk plays an equally important role. What kind of risk you take? Only if you analyze that, you will be taking calculated risk. Without analyzing risk, you are taking blind risk. So paying attention to risk is something more important. Focus on risk, find ways to manage risk. That is the sure shot way to earn above average consistent return. Based on the Riskometer, based on the SEBI categorization Riskometer, this fund falls under very high risk category, because any equity fund which is investing only in equity will fall under this very high risk category. This is suitable for very aggressive investors, investor who is willing to accept very high risk to maximize the potential returns can choose this fund. There are a few important key ratios to measure the risk. I will take a couple of pointers here. One is standard deviation. Standard deviation is 21.37%, which we have to infer it as high volatility. Sharpe ratio is 0.48. That means this fund delivers poor risk-adjusted return. Sortino ratio is 0.52. That means low downside protection. This is important negative observation for this fund. Beta is 0.97%. That means the risk is almost equivalent to the index. Alpha is 0.87% in negative. Even after paying 1.97% expense ratio in this actively managed fund, they are not able to deliver even index return. 0.87% less than the index. So that means this fund has a clear underperformance compared to the index. In the previous slide, we have looked at beta. We have also looked at standard deviation. Both measure volatility, but they measure total volatility. Total volatility is generally not important, or there is no specificity there, because when the market goes up by 10%, if the beta or the standard deviation will tell you the total volatility. If the market goes up by 10% and the fund goes up by 20%, right? It is good for you as an investor. This fund has delivered 20% return, 10% additional return. It's good for you. But when the market falls by 10%, whereas this fund falls by 20%, then it is a negative. It is a negative impact for you. So during upside volatility, we need not worry. Only during downside volatility, an investor has to be worried. So this particular data, what I am giving you here, is a unique data which measures only the bad volatility. Upside volatility is a good volatility, we can ignore. Only downside volatility is bad volatility. I am measuring that. I have categorized this into 4 buckets. Top quartile is the highest risk and the bottom quartile is the lowest risk. 5-year, 10-year, 15-year category, this fund has fallen into the top quartile. In the last 3 years, this fund has come into upper middle quartile. So that means this fund has got a higher downside volatility. This fund has got a higher bad volatility, which is definitely a red flag for this particular fund. We have analyzed the risk from different standpoint. Right now is the time to make some important observation about this particular fund that will help you make a decision. This fund was kind of a monopoly fund in the ESG category for a long time. 30 years of track record gives a good analysis. In the long run, this fund is able to beat inflation. Generally, 5 to 7 years is a suggested time frame to invest. Though it is a 5 to 7 years time frame long-term fund, bumpy road is ahead because of its thematic nature. When the market falls, when there's a correction, when there's a crash, this fund becomes a below average performer because downside risk protection is low in this fund. Being a thematic fund, this has got lesser flexibility and freedom to choose between stocks. So there's a possibility for concentration. So portfolio diversification is poor in this fund. ESG as a concept is something very new to India. So ups and downs are higher in this particular category. Though this fund has delivered reasonably good returns, consistent returns. Similar returns we cannot guarantee. Also, other qualitative parameters like what kind of investment process they have and to what extent they will be able to sticking to the investment strategies consistently, that we have to look at it. It is better to consult your certified financial planner before making to choose in this fund. Why? Because your financial planner knows the holistic picture, a big picture. What is your financial roadmap? What kind of wealth management process you are following? There, what kind of existing portfolio you have? Is there any overlap when you add this fund? What kind of allocation can be given to this fund, or do you have to invest or avoid? All those decisions, a financial planner will be able to advise you properly. If you have any additional questions with reference to this fund or any other mutual fund or any other investment options or anything related to achieving your financial goals, you can book a free appointment with our certified financial planners. I have given you a link for booking this appointment below this video in the description box. We also regularly organize insightful investment webinars to educate the investors with the help of eminent investment experts. If you want to participate in our next webinar for free, just click another link which I have given you in the description of this video and leave your name and email ID. We will send you the invite for the next webinar. Hope you like this video. I'll again meet you in yet another useful video. Thank you. Bye-bye.